I'm John Weber with AM Best. Welcome to our webcast, Rating Mortgage Insurance-Linked Securities. Mortgage-related ILS transactions are relatively new to the market. Like natural catastrophe ILS transactions, they are collateralized and used as a substitute for traditional reinsurance. Several of these transactions have been sponsored by private mortgage insurers. AM Best analysts Emmanuel Modu and Dr. Y. Tang will examine how they evaluate mortgage-related ILS transactions. Now, we're going to meet those analysts in just a minute. We may mention the subject of financial strength ratings. Full explanations of AM Best ratings is available online at ambest.com/terms. Now, if you have a question or comment, you can send it in to us at webinars@ambest.com, and we're going to do our best to recognize it during our program today. At this time, we'll turn the presentation over to Emmanuel Modu, Managing Director, Insurance-Linked Securities for AM Best. Manny?
Yeah, thank you, John. So in today's webinar, we'll cover 4 basic agenda items. The first item will be on the basics of mortgage insurance. The second item will be related to the general transaction structure of mortgage insurance-linked securities, or MILs, as we call them. The third item will be AM Best rating approach to MILs. And the fourth item will be the reinsurance credit to private mortgage insurers that sponsor MILs. So mortgage insurance is a type of credit enhancement for mortgages with loan-to-value ratios of over 80%. And the loan-to-value ratio is a ratio of the loan balance to the market value of the home. And MI is most often used to credit enhance mortgages sold to Fannie Mae and Freddie Mac. An important factor in analyzing mortgage insurance is risk in force. And this is essentially the maximum exposure faced by mortgage insurers that cover losses in the pool of mortgages. Risk in force is a product of the MI coverage percentage and the unpaid principal balance of the mortgage. Let's go through an example of mortgage insurance. Here you have a borrower who takes out a loan for $360,000 based on a property value of $400,000. So the loan-to-value ratio for this mortgage is 90%. The MI promises to pay 25% of the first loss upon a default of the mortgage. And so the risk in force here is $90,000. Sometime later, the borrower defaults on the mortgage, and there's a foreclosure process that the mortgage goes through. And at the time of default, the unpaid principal balance is $350,000. But there are other expenses to be added to that to the claim basis for the mortgage insurance. You have unpaid accrued expenses, accrued premium expenses, and foreclosure expenses. So altogether, the claim basis for this mortgage is $365,000, and a quarter of that is $91,250, which is close to the risk in force, but you can see it's slightly higher because of all the other expenses. Risk in force is not a great measure for the kind of stress losses an MI company will experience in a pool of mortgages. Here you have a pool of 24 mortgages of the same type we just described. So the risk in force for the pool is about $2.16 million. This doesn't tell you much about what the stress losses that the MI will experience. To get the stress losses, you need to multiply the risk in force by probability of default of the mortgages. Here we assume there's a probability of default of 12.5% on mortgages, which is 3 out of the 24 mortgages. So the loss here, stress loss here, is $270,000, which is quite a lot lower than $2.16 million in risk in force. So risk in force is not a great way to measure stress losses. This is the list of the 6 current U.S. mortgage insurers. You can see that their insurance in force is about $960 billion through the end of 2017, and their risk in force is $242 billion through 2017. The ratio of the risk in force to the insurance in force here is 25.26%. That's their MI coverage percentage on the average. Mortgage insurance seek reinsurance through the traditional reinsurance market. You can see in the 4th column, which shows the gross premium written ceded to third-party non-affiliated insurers has grown. From 2015 to 2017, that number, the ceded amount has grown considerably. So in 2017, close to 15% of gross written premiums by the MIs have been ceded to third-party reinsurers. The other market through which MI companies seek reinsurance is through to the capital markets, through mills transactions. These type of transactions began in 2015. And you can see that in 2018, there have been 2 transactions so far of close to $800 million. So in total, there's close to $2 billion of risk in force ceded to the capital markets. But this is really a tiny little fraction of the total risk in force of the 6 MI companies. It really is only about I think 80 basis points of their risk in force. But in terms of the companies that are involved in these deals, it's about 2% of their risk in force. Really still a very tiny amount. These are the 6 transactions we've seen so far. The first transactions were done by Arch/UGC. And Arch and UGC have been involved in 1, 2, 3, 4 transactions. National Mortgage Insurance has done 1 transaction, and Essent Guarantee has sponsored another transaction. The maturity of these transactions is generally about 10 years. Let's now talk about the general transaction structure of the mills transactions. In this diagram, you see the ceding insurer to the left-hand side, USMI, enters into an excess of loss reinsurance agreement with a special purpose vehicle, or SPRV. And this excess of loss reinsurance transaction is based on the reference pool that you see on the right-hand side. The SPRV is capitalized by issuing notes to investors in an amount equal to a portion of risk in force. You can see in the boxes under the class 1, 2, and 3 notes, the percentage you see there is the percentage of risk in force that dictates the size of the classes. The note holders receive a monthly, the note proceeds and investment returns are deposited in the reinsurance trust account, and the note holders receive a monthly benchmark interest rate plus some spread. And that spread really is the reinsurance premium paid by the USMI to the SPRV. Note holders lose a portion of their principal if losses on the reference pool exceed the retained amount by the MI. So in this diagram, the coverage level B here is the retained amount. So the USMI absorbs that loss, which is 2.25% of the risk in force. And the remaining loss goes to the class 3, 2, and 1 notes. And thereafter, the USMI takes on the remaining losses. We made up a hypothetical pool which has the features similar to the features we see in other mills transactions. The important data is shown on this slide. We highlight the current risk in force of about $10.2 billion. The average mortgage insurance coverage, about 25.5%, which is close to the average MI coverage for the MI industry. We have the weighted average loan-to-value ratio of close to 92%. It's 91.6% here. The weighted average credit score is quite high, 748. And 98% of the pool is made up of fixed-rate mortgages. This is the liability structure of the transaction. As you see here, Class 3 notes. The Class 3 note is not attached until the ceding insurer absorbs the first $230 million of losses. This means that the Class 3 subordination level is $230 million, which is about 2.25% of the risk in force. The Class 2 note is not attached until after the ceding insurer absorbs the first $230 million of losses, and the Class 3 note is wiped out. This means that the Class 2 subordination level is $255 million, or about 2.5% of our risk in force. The Class 1 note is not attached until after the ceding insurer absorbs the first $230 million of losses, and the Class 3 and Class 2 notes are wiped out. So you can say that the subordination level for Class 1 is about $470 million, or 4.6% of the risk in force. Thereafter, at the exhaustion of Class 1 notes, at the attachment of the coverage level, all the losses after the Class 1 note is exhausted is absorbed by the ceding insurer. And in this case, the ceding insurer does not absorb losses again until the coverage level B is exhausted, which is the ceding insurer's first loss position, and Class 3, Class 2, and Class 1 note is exhausted. So you can see the subordination level for the ceding insurer, coverage level A, is $740 million or so. That's a subordination level of 7.25%. This subordination level is important later on in terms of the trigger of principal allocations. We'll discuss later. In terms of loss allocation, it's just what we just described. The loss allocation begins from the lowest tranche, which is the coverage level B, absorbed by the insurer, and it goes up to Class 3, Class 2, Class 1, and thereafter the loss is absorbed by the mortgage insurer. The hierarchy for the principal allocation is a bit more complicated. Here we have, let's first define a couple of coverage levels. The first coverage level is coverage level A, which is shown in green, and it's got about $9.47 billion of the risk in force. The remaining coverage level, which we'll call RCL, is about $741 million. The principal is allocated on a prorated basis between CLA, class coverage level A, and RCL. But within RCL, principal is allocated sequentially. So for every $100 that comes in through principal, amortization, and prepayments, initially, $92.75 goes to coverage level A, and the remaining $7.25 goes to pay down Class 1 first, and after Class 1 is gone, Class 2, and so on. So you can see that the liability structure allows for a pay down of the coverage level as well as the notes themselves. So in the prior slide, the pay down in our principal is based on when things are going great. But when things are going poorly, and I'll define that later on in the next few slides, when things are going poorly, all the principal allocation goes to class coverage level A. And so the class 1, 2, and 3 gets nothing until the conditions are great again. So what do we mean by when things are going great or not so great? Well, when things are going great, it means that the 60-plus days delinquency rate is less than 5%, and the subordination level for CLA is greater than or equal to 7.25%. And this means that the allocation of principal goes the way we described. That is, the coverage level A and RCL get a pro-rata share of principal. But if things are not going great, it means that the 60-plus days delinquency rate is greater than or equal to 5%, or the subordination level for coverage level A is less than 7.25%. In that case, all the principal is allocated to coverage level A. This is a diagram, a slide that shows the pay down of the notes. You can see how fast the notes are paid down. Look at the Bell-Mead-Reed transaction, which is the one highlighted in green. You can see that the M1 tranche is paid down completely. The M2 tranche has been paid down by 50%, and so on. Even the Bell-Mead-Reed 2 has paid down as well. So these structures actually, in these structures, you have a quick pay down of principal. In some cases, we understand that, we believe perhaps in the Radnor Re case, there may be a lockout period for pay down of the first tranche. But generally, in the deals we've seen, the top tranches do pay down quickly. Overall, there's been about a 24% reduction in the principal amount based on the quick pay down of the notes. I'll now turn this presentation over to Wai Tang, who's going to talk about how we actually rate the Mills securities.
Thanks, Manny. So in this section, we'll talk about the AM Best approach to rate the mortgage insurance-linked securities. As Mills are securities, we will assign long-term issue rating, or IR, to the notes. The IR ratings has 21-point scale from AAA to C. AAA is the highest credit, while C is the lowest one. In this slide, we show the idealized issue default matrix, which will be used later to determine the implied rating of the Mills. The methodology used to rate MUs is best insurance-linked securities in structures methodology, or BILSM, while the criteria is evaluating mortgage insurance. The information that AM Best will be reviewed for the rating purpose is pretty standard in the liability structure transactions. So whoever interested in it can find the information in the BILSM methodologies. So I'm not going to get into detail here. In this type of transaction, loan level data is always available. So AM Best would use a third-party credit model, the loan kinetics from Andrew Davidson, to calculate mortgage loss related to the reference pool. Loan kinetics takes loan level data as input and output the monthly loss number at various confidence levels. The key risk factors that included in the model can be broadly categorized into either micro factors or macro factors. Micro factors are loan level data. Among some of them are the credit score and loan-to-value ratio. Macro factors are macroeconomic factors. They are home price appreciation and interest rates. These two macro factors drive the default rates, severity, prepayment rates, and transition rates. The output from the models are results corresponding to 20 different scenarios. The scenarios that we are most interested in are the base scenario and some of the stressed scenarios. Each scenario is correlated with a cumulative distribution function, or CDF. CDF can be interpreted as the probability that the associated or lesser severe scenarios will happen. The CDF of the base scenario is 15th percentile, the median. Stress scenarios are scenarios with CDF greater than 15th percentile. In the range of 18 or higher percentiles are the ones that we are interested in. For each scenario, the model outputs monthly prepayment rates, default rates, loss severity, and aggregate loss of MI coverage for the whole portfolio until the maturity of the portfolio. As mentioned in the previous slide, there are base scenario and stressed scenarios. The stress scenarios are obtained by applying stresses to the base scenario. Stresses that applying to the base scenario are economic stresses and model stresses. Economic stresses are stresses on macro factors. In the interest rate case, it will be the parallel shift of the whole yield curve upward. In terms of home price index, the home price will fall down with a certain percentage and then come back gradually, while in the base case, base scenario, the home price index always going up. Another stresses are modern stresses, which take into account the effect of model error. Therefore, it is stressing the parameters used in the equations to come up with the default rates, loss severity, and prepayment rates, which are driven by both micro and macro factors. Besides that, there's also a global stress which can be applied to all scenarios that include the base scenarios. This global stress is different from stresses that we are just talking about here, which are the stresses that we are talking about here are used to bring us from the base scenario to higher CDF scenario or stress scenarios. To determine the rating of the security quantitatively, we will run the reference portfolio through ECHO model, the loan kinetic. Global stress that we just mentioned previously will be applied to all scenarios. The rating committee may ask for higher or lower global stress. As subordination level of each class of securities is the mortgage loss level that the principal of that class of notes started to suffer, we'll find the scenario that its cumulative loss in 10 years' time is equal to the subordination level of that class of note. We will show the process in detail in the next few slides. After that, we will determine the period in which the losses hit each class. We will call this time to attachment. In this presentation, we assume that it's always 10 years, the legal maturity of the notes. In rare cases, the time to attachment can be less than legal maturity, especially for Class 1 note. However, it is quite technical. I'm not going to go into details here. From the CDF associated with the class of notes, we can calculate the default probability of that class of notes as 1 minus CDF. From both the time to attachment and probability of default, we can correlate that to best idealized issue default matrix to obtain the implied rating. Please be aware that this implied rating is only derived quantitatively. There are other qualitative considerations need to be taken into account before getting to the final rating. And the final rating is determined by a rating committee after taking into account of various risk factors. Well, before I continue, I just want to remind the audience that we are always using the hypothetical transaction as example. In the next few slides, we'll use note class 1 as an example to show how to get to the CDF from subordinated level of class of notes. Remember that subordination level of class 1 note of the hypothetical transaction is 4.6% of RIF. From the model output, we list the 10 years cumulative loss of the reference pool in descending order, as shown in the table on the right-hand side. For each loss number, there is a CDF corresponding to it, shown in the column next to the loss number. We can see that the CDF is also in descending order, just like the loss number. Default probability is in the last column, which is 1 minus CDF. In this example, you can see that the CDF corresponding to class 1 note is 96.35%, and its default probability is 3.65%. Here is the summary of the results for the hypothetical reference pool. The results shown here are related to the hypothetical transaction only. In general, the result will be different for different transactions. The last row is in green is the base scenario, which serves as a reference. First column is either loss or subordination level. Column 2 to column 5 are the stresses on the economic factors. Second column is the shift in interest rate in basis points. The other 3 are house appreciations. Column 6 to 8 shows model stresses. MDR is the monthly default rate. Column 9 is the CDF, and the last column is the default probability. One can see that in the base case, no shift in the interest rate. HPI is always increasing. Stress on MDR, severity, prepayment are 1. That means no stress. Let's look at the class 1 note, which is the first row here. This with the subordination level of 4.6%. There is 96 basis point shift upward in interest rate. HPI down by 15%. Model stress are 19% increase in MDR, 10% increase in severity. Prepayment is lower by 20%. All this relative to the base case. All these model stress here are on top of the macro stress. For the next few slides, we will show the HPI, default rate, severity, prepayment rates, and aggregate loss over time. Here is the HPI over time. One can see that for the base case, which is the top line, is always increasing, about 4% annually, while the class 1 note case, which is the bottom line, down 15% in 2 to 5 years' time, and then gradually come back, but never get back to the original level, even in 10 years' time frame. The annual default rate for all cases shown here peak from 40 months to 60 months. The top line is the Class 1 note scenario, which peaked at about 1.1%, while the base case, the bottom line, peaked about around 0.2%. The Class 1 note case is nearly 4 times that of the base case. The top line is the prepayment rate of the base case, which plateau around 9% after 9 years' time. The bottom line, which is the Class 1 note scenario, is flat after 2 years' time. At the level of 4%, this is only half of the base case. Here, the severity is associated with RIF, not UPB. As expected, it's very high, even in the base case, as shown in the bottom line, because mortgage insurance is in the first loss position. The severity of Class Note 1 can be as high or higher than 100% here. This is corresponding to what many discussed about earlier in the presentation, that the claim base can be higher than the original RIF after taking into account of unpaid accrued interest and expenses associated with foreclosures. This slide is the most interesting one. It is the cumulative loss. At year 10, one can see that the cumulative losses of the reference pool are same as the subordination level of all the corresponding classes. For example, the top line here shows that the cumulative loss of Class 1 note at year 10 is 4.6%, which is exactly the same as subordinate level of Class 1 note. Here we summarize all these quantitative results. For all the note classes, time to attachment is 10 years. Default probability is 3.65%, 14.71%, 19.72% for Class Note 1, 2, and 3, respectively. With time to attachment and default probability, the best idealized issue default matrix implies the rating of Class 1 to be BBB+, Class 2 BB, Class 3 BB-, absent other considerations. In the next slide, we will show the way to determine the implied rating. Here is the best idealized default matrix. As the time to attachment is 10 years, we will focus on row 10. Remember that for Class Note 1, default probability is estimated to be 3.65%. The number in this entry is 3.65%. So the corresponding, which is the nearest, the closest to the 3.65%, and the corresponding rating is BBB+. Implied rating for Class 2, Class 3 can be determined similarly. Once again, I want to remind the audience this is not the final rating. The final rating will be determined by rating committee after taking into account of all risk factors. Quantitative result we show here is only one of them. This slide is just repeat what I have just discussed, so I'm going to skip that. As we mentioned, other than quantitative considerations, qualitative considerations are very important in the rating process. Some of the items we will consider are the credit risk of the sponsor paying premium to SPRV. However, in some cases or in some deals, the transaction structure may mitigate this risk, and that will not be applicable then. Another item we want to emphasize is the quality control of the origination of mortgage loans. During the financial crisis in 2017, One of the reasons that mortgage did not perform well was the quality of the loan originated during that period was pretty poor. This concludes the section. I will hand over the presentation to Manny.
Thanks, Y. So while the rating of the Mills transactions are very important and interesting, we believe that what PMIs most care about is probably the amount of reinsurance credit they'll get for sponsoring these transactions. As many of you know, AM Best has a capital model called BACAR, which helps us evaluate balance sheet strength. The BACAR is made up of two main components, which is available capital and net required capital. So an MI that sponsors a Mills transaction will reduce their net required capital. And I'll go through how that's done in the next few slides. This is the formula for net required capital. You can see that it has basically 8 components. Fixed income securities risk, equity securities risk, interest rate risk, credit risk, reserves risk, net premiums written risk, business risk, and potential catastrophe losses. These items are plugged into the net required capital to calculate the NRC. Now notice that the NRC is calculated for 5 VAR levels according to our methodology. And the VAR levels are 95, 99, 99.5, 99.6, and 99.8. Ultimately, an MI that enters into the sponsors in the Mills transaction will have its B5M, which is reserves risk, reduced somewhat. So let's take a look at what's on this slide. B5M insurer represents the reserves risks of the MI before any reinsurance. So now some of the risks may be retained by the MI company and some may be ceded to the SPRV through the Mills transactions. So our task is to figure out what B5M will be, which is that the reserves risks are retained by the insurer after ceding to the SPRV. So we have to calculate that. And once we calculate that, we can then plug it into the NRC formula to calculate the BACAR ratio. Generically, how we calculate reserves risk is we begin with a reference pool, and we calculate the losses in the reference pool, and we determine how fast the losses develop in that reference pool. And based on that, we can calculate the premiums accruing to the pool based on how fast premiums accruing to the pool. And then we can also, fourthly, calculate the reserves risk as a PV of the losses associated with the reference pool less the credit for premiums. Specifically, how we calculate, I guess, reserves risk for the Mills transaction is that we begin by looking at the gross losses at each VAR level. From that, we can also determine the ceded losses at each VAR level. Then we can then calculate the present value of the ceded losses in the Mills transaction for each VAR level. And then we can calculate the PV of the premiums that accrue to the ceded losses in the Mills transactions at each VAR level. Now, the premiums are really the spread over an index that's paid to the note holders. So to calculate the reserves risk for the Mills transaction, which is B5M Mills, it's simply the difference of item 3 and item 4. This is a representation of what we just discussed. So on the right-hand side, you have this, the ceded discounted loss, which is CDL, which is effectively the loss absorbed by the note holders in the Mills transaction at each VAR level in the reinsurance transaction. We have to subtract from that the premium ceded by the MI to the SPRV at each VAR level. And the difference of those two gives you B5M Mills, which is the reserves risk associated with the business ceded to the SPRV in the Mills transaction at each VAR level. So what we're trying to solve for B5M Mills, obviously. To refresh your memory, this is a transaction structure. We begin with a risk in force of 10.2 billion. The note balance initially is 511 million. The first loss position is 230 million. And the coverage level A is got 9.47 billion. So let's take a look at a couple of VAR level analyses. So at the VAR 99 level, we can calculate ceded nominal loss and gross nominal loss based on the CDF from our model. You can see here that we've done so. We have the gross nominal, which does not exceed the detachment point of the Class 1 notes. And we have the ceded nominal, which is really what we want. The present value of the ceded nominal loss less the PV of the premiums is the reserves risk at the 99% VAR level. Notice also that the coverage level A has gone down considerably. Initially, it was $9.47 billion. It is now, at this VAR level, $4 billion or so because of the principal amortization, right? All the allocations are going mainly, the principal allocations are going mainly to the coverage level A. Some allocations going to class 1 because it's gone down from 271 million to 228, but not much. And the rest of the classes are maintained, the balances are maintained. At the VAR 9.8 level, the same thing applies. We calculate the ceded nominal loss and gross nominal loss based on the CDF from our model. But note that the gross nominal loss actually breaches coverage level A. Also note once again that coverage level A is paid down by about 5-point-something billion because of the principal, the schedule amortization and prepayments. Class 1 is paid down slightly as well. Ultimately, we calculate the PV of ceded nominal loss less the PV of premiums, and this is the reserves risk associated with this level. This slide shows more detailed calculations for the B5M mills, which is the reinsurance credit, which is shown in green. Once again, we begin with the nominal loss top. From that, we can calculate the ceded nominal loss, and then we discount the nominal loss to get the ceded discounted nominal loss. We also tabulate the premiums, which is the spread paid to the note holders effectively. We take the difference of item 3 and 4 to get effectively the reinsurance credit that will accrue to an MI company that actually is involved in a mills transaction. So what do we do with this number? So, so the credit is B5MI mills, which is in the green. So now we need one more thing, of course, B5M insurer, which is the reserves risk faced by the MI before any reinsurance transactions. We calculate this in the rating process for the mortgage insurer. Taking the difference of these two gives us the new B5M, which is the reserve risk retained by the mortgage insurer after the mills transaction. Given the B5M, we can now then plug it into our net required capital formula and calculate the NRC for each VAR level, and then calculate our BOCAR ratio, which is needed in the rating process. And that concludes our presentation for today.
Manny, why? An outstanding presentation, very informative. The slides will be available to registrants?
They will be.
Upon request.
That's right, yeah.
And we have no questions for you, but we would like to let our registrants and viewers know that a complete replay of this webinar will be posted within the next day or so. We'll have a transcript in the next couple of weeks. Once again, the slide deck will be available upon request. For AM Best, I'm John Weber.